You know how much I hate to talk about taxes, but today I'm doing a rare exception for you guys. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well still in this freezing Quebec. I just come back from Guadeloupe, so definitely not a good timing to talk about taxes on top of that. So Vero, what's up with this idea? Like, what's going on here? It's kind of like an ambush this morning.
Well, February rhymes with taxes in Canada, so that's pretty much it. And also, tax optimization can turn into a rabbit hole quite fast, right?
Yeah.
So today we're trying to keep it simple, like we're going to share what matters, what doesn't, and what to avoid when you're maybe sitting on a big gains in a non-registered account. We'll also talk about the dividend tax trap, TFSA positioning, smart withdrawal order in retirement. Like we cover a bunch of stuff, so it should be interesting, even though it's taxes.
All right. That's fair. That's fair. I mean, just small disclaimer. Today, the goal is to give you more kind of like frameworks because, of course, each situation is different. So a good tax advice for you could be a terrible one for your neighbor and vice versa. But we are going to give you some tools to understand if it's applicable to your situation. And there are a lot of things actually. We're going to talk about that, but I'm a big fan of the Pareto principle where you do like 20% of the work and you get 80% of the result. And with tax optimization, it's pretty much the same thing. Yes, you can go on for like 52 hours to optimize your situation and save $1.52. Is it really going to make a difference in your life? So we're going to talk a little bit more about the 20% and skip some part of the 80% because you're not going to get much out of it anyways.
All right, Mike. So when someone says tax optimization, what actually moves the needle versus the stuff that people obsess over that barely matters?
Yeah, let's get started right away. When I read that question in the prep, it kind of reminded me of the tax planning day that I had as a training session as a financial planner. So every year we had tax experts that were like super excited to show us how our clients with a holding company could save like $437.52 out of $1 million revenue. And they would like line that up for like an hour or so to show us how optimized it could be. And I'm like, well, that's great. My client's going to laugh because he just made $1 million in revenue. So he doesn't really care that much about that 400 bucks. But I mean, they were pretty happy about it. So this is where I think it's important to not, as you use that word, obsess over taxes, even though if you're Canadians, you are paying a lot of tax. And I get that.
Right.
And it's frustrated. But the best way to avoid all those taxes is actually to leave the country. So if you're still living there, you have to eat up a lot. So what really moves the needle is simple principle. So you have the 3D to start with, and we're going to talk a lot about it today in the show. So the first D is defer. So postpone the moment you will have to pay taxes as far as possible in time because your money can continue to compound. You don't pay tax on that. So that's great. So that's one great principle. The other one is to divide. A lot easier if you have a spouse, if you have children, so you can divide some of your income. You can build a trust if you have like a sizable portfolio or a business. Those are things that you can do. So dividing your income or the famous income splitting at retirement with your spouse, that's like a classic way to do it to reduce the taxation. So divide whenever you can. And when you're in the accumulation mode, deduct. So anything that you can withdraw from your declared revenue, such as like RSP contribution. So again, the play is always to hit that highest marginal tax bracket and try to do everything legally possible to go down. I say legally because there are a lot of aggressive tax strategies, if we can put it that way. But the CRA has always this like card on their sleeve saying, well, if we determine it's aggressive, well, you're going to pay tax on it. So just make sure that if you found a miracle solution, just be careful about that. And globally, the thing that helps you into retirement when you do tax optimization is to keep your tax rate about the same at all times. So kind of like the
Mhm.
smooth tax rate, not trying to not pay taxes for like 3 years and then build a tax bomb that you're going to pay later. You can run different scenarios, but most of the time, the best one is really to have a smooth tax rate. What doesn't move the needle is when people starts obsessing. And one thing that I see a lot is to put tax optimization first. So first above the investment strategy, above your plan, above anything. So you're making your financial moves for the sole purpose of not paying taxes. When you're thinking about that, then you're going to end up maybe paying fees, maybe investing in underperforming investment products just for the sake of paying less taxes. And I'm like, yeah, you pay less taxes, but you're getting less returns or you're paying more fees. So in the end, are you
Mhm.
really saving something? Getting out of your strategy just to avoid taxes, that, and we're going to talk about it a little bit later, but there is a withholding tax on US dividends. So it's a
Mhm.
15% withholding tax. There's nothing you can do about that. But I mean, if you have to pay 15% tax on the Microsoft dividend that is like 0.30, 0.50, 0.70% yield, is it really going to move the needle, or is it the capital gain that is going to change something in your strategy? So if you're avoiding stocks just for the sole purpose of keeping your tax low, you're also ignoring all the money that you leave on the table by not following a clear strategy and by not selecting the investment products that should fit within your plan.
Right. So now, a situation we are used to seeing is someone having large unrealized capital gains in a non registered account. What are the top mistakes you see them make, and how would you manage this?
It's definitely not, I mean, it's a good problem to have, but it's not a easy problem to solve. The biggest mistake that I see is you fall in love with a good stock, which is on one side a really good thing because you see those returns building, 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 and you're just like, yeah, I make so much money, but then you never sell. So when you never sell, well, you didn't pay taxes, which is great. But now, first, your portfolio was not balanced anymore. And I had that discussion with a client back then when I was a financial planner, and he had like 45% of his portfolio in Apple. I mean, he made a ton of money back then. He was super happy about it. But at the same time, if Apple goes down, his entire plan goes bust. So
Mhm.
you're increasing that kind of level of risk. Some people are good with that, so that's fine. With some others, you will like to think about it. You're also building a tax bomb because one day or another, someone will have to pay that taxes. And if you're forced to pay those taxes because you're forced to sell at one point to generate income, or you die and then your estate is stuck with that big tax bill, it's not planned ahead, definitely not optimized. So that could
Mhm.
incur more fees and more taxes to be paid than anything else. Or sometimes what happens, and we see that a lot. I mean, when we talk about investing, I always say that you should review your investments every quarter and do kind of like a bigger overview every year. Because sometimes the company that was once great for decades is becoming mature or not finding growth vectors, or the environment has changes and it's not performing anymore. But now, because you're sitting on a huge capital gain, you kind of stop benefiting from the next move that you could make if you would allocate your capital elsewhere and you keep an underperforming stock moving forward, again, just for the sake of not paying taxes. The second mistake that you can make is, of course, sell everything in 1 year and then trigger way too much taxes. And this is usually the problem where you say, okay, so I have like some sources of income. So I have like a base income that I declare. And if I declare any capital gains, I'm going to get hit by the tax man. I don't want to do that. So it's not that easy to resolve. So the clear solution for me is to plan ahead and trim gradually. avoid to build that huge capital gains of like $500,000 on one single stock. You can trim, and then if you really like the stock, it doesn't prevent you from putting some of that money into a TFSA or a registered account. You save taxes on capital gain moving forward. But if you don't plan ahead and today you're kind of stuck with that huge capital gain, of course, you can try to sell on a year that you will declare a little bit less income. So maybe you can actually stop working earlier. That could be one solution. Another solution would be to find those losers in your portfolio, try to put as much losses as possible to offset some of that capital gains. And even if it means to buy back those losers after the delay that you have to observe. So that's another solution. But I mean, there's no magic wands here. You're still
Hmm.
going to get stuck with the problem. So the solution is really to review your portfolio each year and to make sure that one stock doesn't become like 45% of your portfolio with a like hundreds of thousands of dollars of capital gains. Even though it's a great problem to have, it's never fun to pay a lot of taxes on that.
Right. You kind of quickly mentioned retirement. So, if the investor is close to retirement, does that change the capital gains plan?
Yeah, because you can then plan a little bit more. Because the problem when you have huge capital gains and you're still working is your base income is still relatively high. When
Hmm.
you get to retirement, as I just mentioned, you can decide to retire a year earlier and then trigger like $70,000 of capital gains. That is just going to be $35,000 in declared income that you have to pay
Hmm.
taxed on that. You pay taxes only on 50% of the capital gain. So that could be a solution. Another thing that you can do is that you can delay CPP and OAS, so government benefits. If you postpone them until the age of 71, well, then the advantage you have is you're going to get a bonus back then versus if you have taken them at the age of 65. But also, if you use your capital gains in between, you're again using this smooth tax strategy where you don't hit a higher tax bracket and you're able to get rid of some of the capital gains. Another one, if you have a defined pension plan, most of the time the defined pension plan is synchronized with your CPP. So it means that they project that you're going to retire and take your pension at the age of 65. And they also project that you're going to receive CPP at 65. So sometimes they will say, well, you can take your pension at 60, get a bonus, like get a higher amount, and then it's going to be reduced at the age of 65. So if you do that, you can also say, oh, I'm going to use the capital gains to average up this period so I can make a little bit more money. And you can play with those kind of gaps. Again, nothing magical here, but those tweaks could end up into a few $1,000s that you save in taxes, which is kind of
Right.
cool as well.
Hmm. And now, what types of holdings tend to be more tax efficient in a non registered account?
Yeah, so then we go to what to put where type of
Hmm.
situation. It always depends first on your investment strategy and your allocation. So the point in general is to defer. So you want capital gain in the non-registered account because if you have investment that generates interest or dividends, even though if you reinvest those interests or dividends, you're still going to have to pay tax on them. So they're going to be declared on the year that you earn them. If it's capital gain, as long as you don't sell, you won't have to pay for that. So it's always better to put some growth investments or your equity stuff in the non-registered as opposed to put bonds, for example, or
Hmm.
GICs, because then you're getting fully taxed on interest income immediately when you earn it. Another thing that you can do is that if you have Canadian dividend stocks, while they're more efficient than US dividend stocks because they benefit from a tax credit in the non-registered. So US stocks don't do that. So there are a few tweaks here, but in generally speaking, the best way to use the non-registered is to put the growth portion. But that is, you need to have in your investment strategy, in your allocation, some interest to invest in equities. Because some people, they're just like, you know what, I'm done with the stock market. Well, even though it's not tax efficient, there's no point of paying less taxes but not sleeping at well at night because you have equities in your non-registered while you should have bonds and preferred shares.
Hmm. So, moving to TFSAs, what belongs in them in your mind and what doesn't?
Well, you can put pretty much whatever you want in a TFSA. The only difference with the registered accounts such as the RSP is the fact that there is the withholding tax rate on US dividends. So by definition, it's 30%. Once you complete the W8 BEN form, you can call your broker for that. It's going to go back to 15. But once it's at 15, there's nothing you can do. If you receive $1 in US dividend, you're going to pay 15 cents. You have to deal with that. So of course, if you have high yielders that are US companies, probably not the best idea to put them in your TFSA. You might want to put them in RSP because the tax treaty where it says that there's no withholding tax on the US dividend is only applicable for retirement accounts. And even
Hmm.
if you use your TFSA for your retirement, the account itself is not deemed to be a retirement account. So therefore,
Right.
it's not good under that treaty. So it's only the RSP, the RIF, the LIRA, the LIF, and the likes, but not the TFSA. So besides high yield US stocks, pretty much you can do anything here. So if you have like REITs, for example, they're a little more complicated with taxes. If you have any investment that offers a return of capital, which will affect your cost base, it's probably easier to manage those type of investment in a TFSA because the taxes are not existent instead of like the non-registered. But you can put like whatever you want, could put in emerging markets, you can put penny stocks. When the account was created, I know that a lot of people were just using the TFSA as a savings account because they were thinking, oh, I can put my emergency fund in there and it generates that like that interest that I don't pay tax on at. I mean, it's true, but I would probably try to think of the TFSA long term instead, because the great thing is, and we're going to talk about that in terms of like when to withdraw from which account.
Hmm.
But the TFSA in general is among the last account that you're going to take your money out of at retirement. So if you have a long-term strategy, you can compound a lot. And if you like, whenever you withdraw or if you die, that money will not be taxed. Like there's no gain, there's nothing taxable there, as opposed to building a huge RSP that turns into a RIF, but then you have like $1 million there. If you die and your spouse die, well, then it's going to go to your estate with a roughly 50% tax bill, which is probably not what you want. So the TFS is
Right.
probably the account that you want to keep as long as possible for those reasons.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. I'm adding a question here, Mike, because I just realized that maybe a lot of investors started investing not necessarily thinking about those rules that you've just mentioned about different accounts. So when is it time to do like a accounts cleanup? Like, is it like 5 years before retirement, as soon as possible in retirement? Like, when would that be the best timing?
Sometimes I see people thinking, "Oh, I'm going to do retirement planning and my projections like a few years before retirement." And they think they're going to be good. The plan is going to be more precise, and it's a good way to do it. Yes, because you know exactly where you're getting to, but it's worth it to start doing some rough financial projections, even if you're in your 20s, if you can. So, I mean, if
Mhm.
you're listening and your children are in their 20s, like just let them listen to the next 5 minutes. Because here's the thing: imagine that you have a huge pension plan. Your intention is to work at the same place for a long while. First, you're going to have a small amount of RSP room contribution. And the second thing is the day that you're going to retire, your base income is still going to be relatively high. So if you withdraw money from your RSP, it's just going to be adding up to your existing income, as opposed to contributing first to your TFSA, for example, in this case, because then at retirement, you can withdraw as much as you want from the TFSA and it's not going to play around with your taxes where your base income is still going to be relatively high. So
Mhm.
knowing the difference between where to put your next $5,000, should it be in your RSP or in your TFSA? If you make those right decision in your 20s and 30s, then it can compound and makes a big difference down the road. For some other people, you're going to run those projections and it's going to be the same. Like roughly, you're going to get a deduction from the RSP, which is going to be good if you reinvest that deduction back into the account and then you wait until retirement. It's going to be roughly the same equivalent as if you would just put money in the TFSA. Some other people, it's going to be better for the TFSA, but you don't know if you don't run those calculations. So first, start with a good plan. Wherever you are in your financial life, like start thinking about, okay, so I need to know how much I'm saving, where I'm going with this, and always see retirement planning as a long trip itinerary, like a 1 year trip, as I did with my RV. When you start at the beginning, you're just like, okay, it's just looking at the horizon, like where I want to go. It's rough. It doesn't have to be precise, but it's going to give you a direction of at least knowing if you take RSP or TFSA or if you make a combination of both. Then you can review your financial situation every time that your plan may change. You change job, you get married, you buy a house, you have children, you have a lot of like important event in your life that may or may not have an impact on your financial. And this is usually the moment where you should review that projection and say, okay, so now I'm divorced. I have to sell the house. It's going to completely change my plan. Where should I invest now? So those
Mhm.
are the moments that will have a big impact, and it's the right time to do that cleanup with your account.
Right. Okay, so here is another situation commonly shared with us. It goes as follows. My RSP is mostly growth stocks. Should I withdraw from it even if it means selling winners? How do you answer that?
Yeah, I get this question a lot, and a sub question. Hello, Todd. Is if you have a lot of U.S. stocks in there too. That typically goes along with it because you would put your U.S. stocks first in your RSP because you avoid the withholding tax, and then second reason is sometimes the U.S. stocks will be known to have a better growth factor as well. Not that if you
Right.
invest in the Keene stocks, it's not going to happen, but if you're thinking about like tech stocks, for example, well, most of them are US. So there you go. And then you get to retirement and it's just like, oh, damn, I have to sell all my best performing assets. I don't feel like it. Like, how do I do that? So it's important to not focus too much with a strategy by accounts, but rather have a global strategy. So eventually,
Mm.
when you get to retirement, well, then you might as well just invest a little bit more in US stocks in your TFSAs. So you have like a better balance, even if it means that you're going to pay 10% with a 15% of withholding tax on your shares of Apple at the 0.42% dividend yield. So what's the most important part when you invest in Apple? Is it the growth or the dividend? Well, definitely the growth, right? So having
Mhm.
growth stocks in your TFSA is not that bad, even if you have like small dividends. So the only thing I would avoid is to have like those 4 or 5 yielders that are US companies to put them in a TFSA. For the rest of it, I would try to maybe rearrange at retirement your allocation so you can have something interesting in your RSP, but something interesting also in other type of accounts. And of course, prepare that portfolio that you have to withdraw from by building a cash wedge so you're not forced to sell winners at a bad time.
Right. And what's your view on early RSP withdrawals, like before government benefits kick in, to smooth lifetime taxes?
So there's a great moment to do some tax optimization when you're about to retire, and it's because you will get several revenue sources with different tax rates and different timing. So you may have defined benefit pension plan, you will have your investment accounts, different types of accounts, government benefits, rental income, and maybe a side gig as well. So plenty of things that you have to play with. Run different scenarios. This is what we do at Retirement Loop because we have built this spreadsheet that help people to run all the scenarios they want. So if you want to run like 20 scenarios, you can do that, which is kind of fun. And on top of that, there is an optimizer telling you what is the sequence that you should be using to withdraw money or to generate income in which order so you can minimize taxes and then get the best out of your retirement sources. The best rule here is usually to keep the tax rate as equal as possible. So in your example, withdrawing RSP faster is probably a good idea for many, many retirees. So first, you can just withdraw RSP before and to bridge the gap between the moment you're going to get the CPP and OAS. But you
Mhm.
can also transfer it into a RIF earlier than the age of 71 So you can do income splitting if you have a spouse, which could be nice if you both don't have the same amount of investment. You will also benefit from the tax pension credit of $2,000 as well. And you can bridge the gap income between the moment you get your pension or your government benefits instead of waiting until the age of 71. Because for a lot of people, when they wait until the age of 71, and it's kind of like confusing, this is why you have to run those projections. Because on the one
Hmm.
side, if you wait until the age of 71, you apply the first principle, which is defer. You waited the last minute to pay $1 in taxes from your RSP. So
Right.
the thing is, you may be building a tax bomb on the other side.
Mm.
So if you let your RSP growing into like $2 million at the age of 82 and then you pass away, well, that's a lot of money that you're not going to use and it's going to be used by the government. And we all know that they're not the best one to manage money. They're the best one to spend it though. They're really good at that, but it's not might be spent the way you want it. So that's why there's that balance to, oh, can I do some withdrawals that will smoother the tax rate and not get hit by a 52% tax or a 50% tax rate for my estate? Can I keep it maybe equally at like 18 for the rest of my life? That could be interesting. So this is where you will play around with the withdrawals. Most of the time, there will be a combination of different types of accounts and different types of source of revenue to reach that optimized withdrawal strategy. But you cannot do that without a projection because each situation is
Right.
different. So you need to run those calculations. And this is what I like the best about the retirement loop projection sheet is once you're
Hmm.
done with all those scenarios, you can use the optimizers. And we also offer like the service of a retirement coach that will go through your plan to make sure that you have not forgotten about anything, that you're on track with everything else, and maybe suggest some ideas that have you thought of like trying this and trying that. So not advice, but rather say, hey, there's a world of possibilities out there. There's a world of strategies. You might want to try them as well, just to see if it could work in your situation.
And by the way, I just need to add because it's still worth it. Retirementloop.ca, by the way, but it's just for the spreadsheet. It's worth it, but the doors are closed right now. So you can join the wait list. And
Such a teaser,
also,
right?
yeah, but we have to say it because it has been such a great tool for many retirees in Canada that we are having so much great feedback that I need to also add that it's a community. So you get a lot more than the spreadsheet on top of that. So you get like webinars and you get people to talk to and change, share like tips and all that. So it's really amazing. Retirementloop.ca and you'll get the wait list there. Okay,
Yeah, and
Mike,
in a few weeks, we're going to talk about estate planning, which is going to be
right.
quite a topic actually in February. So if you're a looper and you're listening to that, you're going to love this webinar. We're going to have an expert to talk about it. It's going to be so much fun.
Yeah, for sure. Okay, so let's talk about another setup, Mike.
Of course.
Non-registered. So, what if you have a non-registered and TFSA that are filled with Canadian dividend stocks only? Like, what's smart about it, and what could go south?
Well, I mean, with a TFSA, everything is great. As I said, I mean, there's no tax, so that's perfect. Then you just have to focus on your investment strategy. So if you have all in Canadian dividend stocks in your TFSA, it's great. But just think about where you're going to put your US and other type of investments. So that would be just the one thing. On the non-registered side, well, with the tax credits, probably one of like the great place to have Canadian dividend stocks. One thing I want to highlight though, because I see this comment a lot and say, hey, if you have like a bunch of Canadian dividend stocks, well, you can earn between like $30,000 to $45,000 in dividend per year without paying $1 in taxes, which is true and amazing, but it's not completely true in the sense that it is true as long as you have no other sources of income. So
Mm,
that means no government pension, no side gigs, no other investments that generate income, no rental income either. So it is true for some people. Again, very different setup where people must have most of their money invested in a non-registered account. Forget about TFSA and the RSP because the moment that you start withdrawing from those, you're going to add up income to your
right.
tax bill. I mean, it's a rare situation. It is possible, but it's not necessarily going to last forever because you could decide to delay RSP withdrawals. And then you have to think again, am I building a tax bomb for later, or is it the best way to do it? And it all comes back down to your investment strategy in the first place. So to generate that much more dividend payments, are you stuck by just, I don't know, like solely investing in like Canadian banks, utilities, pipelines, and telcos
Hmm.
and REITs? I mean,
Hmm.
maybe you're going to get stuck there. And even like REITs, most of them are not paying dividends, so they're not subject to the tax credit. So again, be careful with that hyper focus on one thing. Reviewing your portfolio with an accountant or a tax professional could be quite helpful at this point as well. So just too much focus on taxes again could lead to big mistakes without even you
Right.
noticing it.
Okay, so let's go back to withdrawal for a bit. For those near or in retirement that don't have access to a spreadsheet like the ones we have at Retirement Loop, what's like the default withdrawal order? Is it like non-registered first, then RSP, then TFSA, or does it change depending on income sources?
Well, I mean, the best answer is, of course, it depends. But I mean, let's go a little bit further here. So, generally speaking, yes, you should start with your non registered and then RSP and then the FSA. In reality, what's going to happen is probably a combination of non registered, RSP, or RIF at the same time.
Mm,
Rarely to start with a TFSA for the reason that we have discussed earlier, where you can postpone the moment that you pay taxes until forever because there are no taxes. While the RSP, the problem if you postpone it forever is eventually your estate's going to pay the tax bill. So you have to be a bit careful about that part and think about it. If you force to withdraw, like some people are just like super excited to melt down their RSP as soon as possible. Well, think about that part as well. If you withdraw $10,000 from your RSP, it becomes maybe like $8,000 or $7,000 depending on your tax rate, right? Well, that $3,000 will not compound in the future. So if you
mhm,
withdraw that $10,000 10 years before another scenario, that's 10 years worth of compounding for $3,000 that will never happen. In
mm,
an unregistered, if you withdraw 10,000, you're just going to pay tax on the capital gain. So technically a lot less because it doesn't mean that you only sell like huge capital gains. Maybe you're going to have like a 25% capital gain onto that 25K, so that 10K. So you're not going to pay that much tax. If
mhm.
you have pension, rental income, a side gig, RSP withdrawals will be taxed at a higher rate. So you have to consider this as well. So that's why it's usually a mix. Again, going back to the same rule, try to have your average tax rate as smooth as possible and then try different scenarios to see maybe there's a moment in your life where you're not going to declare that much income. And this is where it's time to trigger capital gains or trigger a bigger withdrawal from your RSP and then save some taxes down the road.
Okay, you've mentioned reviewing each year. So, what would be the recurring checkpoints that retirees should revisit every year to stay tax efficient without, I'm coming back with the word obsessing?
Yeah, definitely. I mean, but it's important to have everything in check, right? And to review everything. So you have your financial projection, you retire each year so you can run your numbers and just make sure that everything is there. And then you look at where you have to withdraw money. So different type of accounts. Like I said, the optimized way is usually a combination of different accounts. You want to make sure that they are prepared, meaning that they generate enough income, or that you have a cash wedge so you're not forced to sell on a bad year. And then you keep an eye on your marginal tax rate and the average tax rate. So from one year to another, you just want to make sure that you don't increase your level of taxes for nothing. And then you're going to be good. Like that's enough to, I mean, of course, you do like that cleaning of like triggering your capital gains if you have losses to offset them with, doing income splitting, making sure that all your accounts are in order. And then you're good. I mean, you will cover 80% of tax optimization by doing this 20% steps.
And after this episode, Mike, what do you want listeners to stop doing like immediately?
Putting tax optimization first in their process. The process should go as follow. You do the financial projections because that will also have an influence in your asset allocation. Because without the projection, you don't know how much you need to live. So you don't know how much of kind of like expected returns you need. Because some people would say, oh, I can retire with an expected return of 3%. Well, that's great because it means that you don't have to take that much volatility in your portfolio. It's up to you then if you want to have growth stocks or not, or growth investments or not. So you start with the financial projection, then you do your investment strategy. Once those two things are done, this is where you do tax optimization by allocating your asset in the right accounts, by determining the right sequence of withdrawals, by doing income splitting, this is how you can do your tax optimization, not the other way around, just to say, I don't want to pay taxes. My goal is to go to zero. Well, I mean, sell everything, move outside of the country. It's going to be faster. But I mean, it comes with some other problems too, right?
Yeah,
There's
we've discussed that at Retirement Loop too. I mean, we had a guess, and it's not that simple. Let's put it that way.
yeah, that kind of convinced me to stay in Canada like
Pay
5 months
taxes.
and a half. Like, yeah, and pay taxes like half of the year here. So to deal with that, yeah, definitely.
So now, Mike, let's just end with that. What's the best reason to join Retirement Loop's waitlist?
So yeah, well, first you're going to be the first one to know when we reopen, and it's kind of funny. I had the discussion with a DSR member. Said, "Hey, I tried to join Retirement Loop and it's not working." I'm like, "No, we open like twice a year for about like 2 weeks, so it's like a month out of like 12 that it's
Mhm.
open." So you'll know right there. You're going to get free retirement tips in the newsletter in the meantime, and you're going to start with a big win. We have the 20 income product guide. So we review 20 different types of investment that generate income, from the high interest rate savings account to mutual funds to ETFs to stocks to preferred shares, all kind of stuff. Tontines, they're there. So we give you the pros, the cons, and it's going to help you make the right decision for your portfolio. Because once again, there are thousands of strategies that work. The point is to find one that you understand, that works for you, and that helps you sleep well at night. And this is what the income guide is for you.
So, listeners, hit pause and retirementloop.ca/waitlist to download our income products guide and also to get informed of our next reopening. Thank you, Mike, for helping us focus on what really matters when it comes to tax optimization. For our show notes and related content, visit thedividendguyblog.com/264. Do not miss an episode again. Hit the subscribe button underneath our podcast logo to get notified. And Mike, you did so well about a topic that you don't enjoy that much, and we're going to continue next week with CDRs. So until then, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.